At 6 Meridian, we are committed to exceptional client service and evolving to meet our clients' ever-changing needs in the ever-changing landscape of wealth advisory. That landscape recently changed significantly in the form of the U.S. tax code. In this 4-part series, we will explore those changes and their possible impact on you as you plan for 2018 and beyond. We hope you find this series helpful and informational as you navigate the sometimes complicated world of tax planning. Andrew, how do you see the new tax bill impacting the stock market?
Well, Margaret, the impact, we've already probably felt a pretty large portion of the impact. The House passed the first version of this bill in November of last year. Since then, the S&P 500 is up 10%. So in about 90 days, we've had a 10% move in the major U.S. Equity market, which is an annualized 40%. So a large amount of the benefit we've already felt. But specifically at the company level, there are 3 things that we're tracking and looking at in terms of how it's going to simplify the taxes for companies and also is going to increase the profitability. So the first is the reduction in the corporate tax rate from 35% down to 21%. It's going to have a huge impact for companies that are primarily domestic. So think of companies like Walmart and Verizon. They've already announced, those 2 companies in particular have already announced significant increases in capital expenditures. They've announced $1,000 per employee bonuses. And all of that's driven by they're going to have significantly more after-tax income available. And you're seeing the stocks react to that. The next is the cash that companies have stashed overseas due to earnings that they made in other jurisdictions. So a company that made Apple, for example. Apple has hundreds of billions of dollars of overseas cash that they haven't brought back because it was going to be a very punitive tax rate that they would have to pay to bring it back. This tax law requires all companies that have overseas cash to repatriate, and when they do that, they pay the tax. And Apple's, I think, going to be about $40 billion. And once they do that, then they're able to invest that cash, use it however they want to. And then the third change for the equity markets is a territorial tax system. I think the United States was the last developed market that had a non-territorial system. And the difference with a territorial and a non-territorial is that basically if you make $1 of income in the United States, you pay taxes at that rate. If you make $1 of income in France, you pay it at that rate. In the past, if you made income in a country whose rate was lower than the US, you had to pay an additional tax to bring it back. And so that completely goes away.
Andrew, do you see the new tax bill impacting the fixed income and bond markets?
Not as much as it affects the equity market. So anybody who has debt, any company that has debt, it will change a little bit because they're going to be able to service it in an easier manner because they have more after-tax income. But for some companies who have a very high level of debt, there is a change that will limit the deductibility of their interest expense. So that's on the margin. It's a very small number of companies, but it will have an impact there. A bigger impact for our clients would be the change to a change that's going to take place to the municipal bond market. So municipal bond, there are times where municipalities or other issuers of municipal bonds pre-refund those bonds. And when they do that, they put treasuries in trust, and the treasuries are used to pay the bonds off. And so what you end up with as an investor is a tax-free treasury bond. The new law says when a bond becomes pre-refunded, a municipal bond becomes pre-refunded, it's no longer tax exempt. And so that will change the willingness, I think, of clients to hold pre-refunded municipal bonds.
What industries do you see being impacted by the tax law changes?
When we look at that and think about the industries that are impacted, there are 2 types of industries that are going to win based on the new tax law. The first is the companies that are going to have more after-tax income. So their tax rate is going from 35% down to 21%, so they have significantly more cash available. And those are going to be industries that are mostly domestic focused. So think about financials, so banks in the United States or retailers, Walmart, Home Depot, Lowe's. Most of their business is conducted in the US and they were the ones paying the higher tax rate. The next industry that's going to benefit, or the next set of stocks that would benefit, would be companies that will have more sales as a result of changes that companies are going to make because of the tax law. And the example that I would give is that the immediate expensing of capital expenditures will encourage and probably pull forward some demand. And so industrial stocks, people who make things that other companies want to buy, are going to benefit as those sales are pulled forward.
Andrew, have we seen the impact of these changes in the sectors in terms of stock market performance?
We have. There's been a very clear pattern after the tax law was passed. This chart shows you that the top performing industries after the tax law was passed were the financial stocks and the industrials. And we spoke just a minute ago about why those industries are going to benefit in particular. But also interesting is what didn't react, because not everybody is going to benefit to the same degree. And so when you look at this chart, you see that technology was the worst performing sector. And the reason isn't because it's going to harm technology or it's going to be bad for them. It's that their tax rates were already very low. So if you look at a company like Apple or a company like Microsoft or Google, the tax rates that they were paying were already very low. And so the benefit is significantly less than for the other industries. We've highlighted major changes that have come about due to the new tax law. Every situation is different, so we recommend that you speak to your tax professional as you're planning your tax situation going forward. Thank you for joining us.